Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Wednesday, August 7th, 5:14 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Let's see if I can get through this without coughing. Market state, not a surprise that we're in a correction. You can see the trend gauge over here has just deteriorated little by little, then all at once, starting with market leadership back on 719, then short-term trend, then the medium-term trend, and some of the major indexes are approaching their long-term 200-day moving average. If you followed us day by day, you've seen us decrease our exposure, employ our rules to get the heck out of the way. We're market technicians. We know the difference between a healthy market and a risky market. So what happened today? Started off looking like a healthy market as Japan intervened overnight after just some hellacious action in their currency and their bonds and in their stock market. And they said, okay, we're backing off, leave us alone already. And that prompted a gap up in the morning. But bear markets are prone to strong opens and weak closes, just the opposite of bull markets. And that's what we saw today. So we saw some FOMO at the open, including me, but didn't do anything. It's always tempting to, when you see, especially an earnings reaction in a company that you know is a solid company and has really been beaten down, to take a nibble, but none of that, not in this market. The gap up failed after 90 minutes and then reversed very hard, trended down the last 5 hours of the day. Ugly close, ugly day. Here are the numbers. The big eight down a little over 1%, four up, four down. This was mostly to the downside, led by Tesla and Nvidia. The RG8, our 8 growth ETF composite, all 8 of them down, an average of 1.4%. S&P 500 gapped up 1.1%, went just a bit higher around 10 a.m., based for an hour, and then rolled over, ended up down 0.77%, equal weight down about the same. NASDAQ 100, 1.7% gap up, rolled over to a 1.1% loss, equal weight, down 0.74%. Dow down 0.6, mid caps down 0.8, Russell 2000 small caps down 1.4. Global diversified 60/40 stock and bond down 0.2%. International and emerging markets bounced today. That's why that outperformed. Our flagship GROTECTION portfolio is in protection mode. 20 to 30% in the S&P 500. It's still in some Nvidia, and that's hedged, down on the day by 0.2%. That's where the FOMO comes in. When you see the market gapping up 1% and you're under allocated, the temptation is there to chase. It's just human nature, but gotta have your rules and understand what type of a market you're in. This is not a buy strength market. So let's go to the indexes here, and we'll start off with what we've got here is the 21-day, which rolled over down through the 50-day moving average yesterday. The red line, the 50-day. The pink line is the 150-day. The black line is the 200-day moving average. So the 100-day, which held support back on Friday for the S&P, is acting as resistance if I had it on this screen, which I don't, because MarketSmith only gives you 4 moving averages. So it ran in both of the past 2 days, it ran into resistance right at that level. But the 150-day is acting as support. So we need to see that hold up, or we're looking at a visit of the 200-day moving average, which is now above the 5,000 level. NASDAQ 100, worse. The 150-day is acting as resistance there, much closer to the 200-day moving average after the undercut and reclaim on Monday. Dow Jones Industrial Average. The 50-day is acting as resistance here, as it's these moving averages, the 50, the 150, and the 100 are bunched up very tightly on the Dow. At the 50-day, you can see both of the last 2 days ran into overhead resistance and failed there, and right now just below the 150-day, above the 200-day. S&P 400 small cap playing ping pong around the 150-day after bouncing at the 200-day on Monday, and the Russell 2000 ran into the 50-day today, failed, back below the 150-day, still above the 200-day, which held for support on Monday as well. Let's go to equal weight. Here's the RSP equal weight S&P 500, 50-day resistance the last two days. 21-day has not, excuse me, broken below the 50-day on the equal weighted version yet. And we're sitting on the 150-day moving average on equal weight as well. QQEW after the nasty failed breakout here below the 200-day moving average, just looking terrible, plain and simple. How about the VIX? Saw the big spike earlier this week, pulling back, but still very elevated. The average true range of the S&P 500 has doubled over the last 6 weeks, going from a very nice 0.74% on a daily basis up near 1.5% now. That's casino-like action. And you can see it intraday with individual names and how growth names are getting taken apart. And it's one of the signals that we use for our exposure. Also, an increasing average true range on the S&P 500 is bearish. It got up as far as mid 2.5s during the bear market in 2022. It's acting that way now, just hasn't been there because of the lower volatility days over the past few weeks before what happened starting last week. Is keeping it suppressed, but you can see, I mean, all the way up to 1.5 now. I have that marked on the tail of the tape. So there's the VIX. Let's go to the dollar. Dollar up 0.23%. Not a whole lot of impact on the dollar on seems anything as of late. Let's go to precious metals. Gold, basically flat, tight range, showing relative strength because the market's coming apart. Gold stocks, not so much, breaking the 50-day moving average, down 2.6% today. And silver, also ugly, coming into the 200-day moving average, down 1.3% today. Bitcoin, speaking of ugly, outside negative reversal today, still above Monday's close. Bond market, BND, broad bond market, pullback for the third straight day. TLT, 30-year, I'm sorry, down again. Excuse me. And TYX, a pop on rates for the second day on the 30-year, pop on rates for the 10-year as well. All right, let's go to the tail of the tape. So what do we got here? Japan, as I mentioned, stopped their yen and interest rate changes to stabilizing the market. We're monitoring the S&P and the NASDAQ against these three moving averages. Expectations decidedly negative. That's why we have minimal exposure. Ugly close near the low of the day. You can see the sectors that outperformed. No trades in-house today. Bottom line on the day, gap up, fails late morning, reverses into a trend down day. So we don't really have a 21 over 21 list. We've got a list of stocks that we're watching, and a lot of them are, the list is populated by names that have gapped up recently during this quarter. And this is really what is fueling our watch list going forward when the market rights itself. So what I'm going to do is bring up, we've got 31 names here, and you can see they were all reported over the past couple of weeks, and you can see how they've reacted, and it really shouldn't be a surprise, and it's a reminder not to chase strength. Excuse me. So here's Upstart, gap up today, first day here. Uber, nice gap up yesterday in a glowing report, ran into the 50-day moving average and reversed today. Fortinet, first day up on the gap. We'll see how it looks going forward. Day one gap up, that just gets it on our list. Universal Health, this is a hospital, not so much interested in this because it's not a growth name, but watching how it's holding up. Deckers had a big gap up that promptly failed, was sold with both fists. You can see the gap up here 2 weeks ago and now trying to hold on to the 200-day moving average. Former leader, and most former leaders have broken. Tyson Foods, I mean, it's chicken. I love chicken. Do you love chicken? Gap up out of a base, coming back into the base, but not something we're likely to be buying unless it's for dinner. CBRE, real estate development, want to keep an eye on this. Real estate really has been beaten down, but with longer rates coming back, this got a gap up on earnings and it's holding it. Spotify, gap up on earnings, volatility the prior 3 days, trying to hold on to the 21-day moving average. Melly, one that gapped up and is continuing higher over the past week. GE gapped up, faded, still basing. CRS gapped up, a couple of ugly days, but back above the 21. Sprouts holding up pretty good after its earnings gap higher. Intuitive Surgical, same thing, at least bouncing at the 150-day moving average. 3M, defensive company, holding up over 120. F5 gapped up, held for 2 days, then gave it up, but still above the 21. Generac, gap up, ugly reversal. This nonstop selling since the gap up. That's just institutions taking advantage of the liquidity to get out at the best price that they can. Palantir, this is in our top 5 list. Another great earnings report. AI favorite. It gapped up on nice volume, made a higher high today, but you're not rewarded in strength in this market, and it reversed to end up closing lower on the day, but still in our top 5 along with Uber. IBM, boring company, but showing relative strength, not massive growth, holding the 21 anyway. Howmet, big gap up, pulled back to the 21 and bounced. ServiceNow, volatility after its attempted breakout 2 weeks ago on earnings. Lockheed Martin continues to work. Defensive stocks doing well. And I mean aerospace and defense, not defensive like Staples. Meta gapped up, attempted to bounce, reversed at that 500 level today. T-Mobile, kind of a defensive stock with some decent numbers, decent earnings numbers anyway. Sales, not so much, but maintaining its move up on earnings. Raytheon, another aerospace defense stock, holding up very well. CTAS, breaking the 21 now. This is, they supply uniforms and such for businesses. United Health moved up, going sideways now in a volatile manner over the last couple of weeks, but showing relative strength. MasterCard gap up, then forget it. CBOE, its volatility leads to a lot more trading. They're a beneficiary of that. So this is one that broke out of a cup and handle base and is acting pretty well on nice volume. Also in our top 5 because of that. Not such great numbers, but you get the story with what's going on in the market. KKR, former leader, gap up on earnings, completely came apart after that. GoDaddy continues to just trudge higher. Not great sales numbers, but they do have great earnings numbers. And finally, DoorDash. By the way, these were sorted by their earnings surprise percentage. I don't know why that says negative 309%. There's something off on that, but DoorDash did gap on earnings, made a higher high, and still holding that high volume gap. So this is in our top 5 as well. That's 31 names that have gapped up with varying follow-up success, but you can see follow-up strong success has been few and far between. Most are just bouncing around, buying strength. This is not the market for it. And with that, I'm going to wrap it. As always, like to hear from you. The email's don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you'd like to become a client, email my partner, Dan Stewart, dan@revereasset.com. Reminder, our flagship portfolio is named GROTECTION, designed to grow assets during uptrends. This is not an uptrend. Excuse me. And that's why we've been protecting capital. You know the drill. With that, I'm going to wrap it for Wednesday, August 7th. This This is Don Vandenbord with Revere Asset Management, struggling to tell it like it is. Thanks for listening and have a great day.